Okay, hi everyone. This is going to be the second lecture for chapter 15. So again, what are we talking about here? Entity overview. We originally looked at this right from a legal classification. We looked at, hey, how do you and what are the consequences of legally forming a business? What considerations should you have? We talked about how your legal framework is different than how you're going to be taxed, right? And there's kind of a nexus between those, this check the box regulation where you'll have a default configuration based off of your legal classification, but you can check the box to be taxed a different way. So, for example, a partnership that checks the box to be taxed as a corporation, right? A legal partnership that is taxed as a corporation. We then looked at some of the characteristics, right, of flow through income. Where we're now going to pick up is some of the tax characteristics of corporation income, right? So, okay, you've elected and are taxed as a C corp, right? So, what's some of the deals here, right? So, first off, a corporation, in distinction to a flow through entity, has double taxation, right? It's taxed twice. In other words, what that means is, hey, a corporation makes $100. Well, the entity itself is going to pay 21% on that. And then, like the leftover amount, what's left in the business after that, that's distributed to the shareholder, then the shareholder pays tax on that distribution, on the dividend, right? So, first layer of tax at the corporate level, second layer of tax at the shareholder level, double taxation. So, the way it's taxed at the shareholder level, it really depends on what type of shareholder do you have. Now, in our everyday life, right, if you invest in stocks or bonds, probably the most common thing to think of, right, is just a person buying stock and they would be a shareholder. And that's very common, right? But one of the things that you may not have considered is that there can be other types of shareholders. So a corporation can be a shareholder. So, for example, let's say Apple as a corporation, remember we said that's a separate legal entity that can enter contracts, that can sue and be sued, uh, and can own property. Well, Apple as an entity, a corporation, buys stock of Amazon, right? So then that's great. They're a shareholder of Amazon, but they're a corporate shareholder. An institutional shareholder might be like a pension fund, right, or a retirement fund that buys stocks and bonds. And then alternatively, the last one is there can be a tax exempt or foreign shareholder. So maybe a not for profit entity that owns stock of another corporation. So I just say that because there's different tax consequences for each type. Now, for individual shareholders, right, we're talking about the dividends that are being pushed out to the shareholder. If you're an individual and you receive a dividend from a corporation, assuming it's a preferential dividend, a qualified dividend that receives that preferential rate, the default rule is you're going to have those capital gains tax rates on it. So depending on your level of income, right, you're going to be taxed on that dividend of 0, 15, or 20%. Let's look here at 15.4 to kind of show this. So here we go, 15.4. We are going to have a taxpayer who's an individual who's a shareholder of a corporation. So it looks like, hey, the corporation earns $500,000. It's going to distribute all of its after tax earnings annually as a dividend. Looks like our individual shareholder has an ordinary tax rate of 37%, and her dividend tax rate is going to be 23.8%. So that's a combination of the preferential rate, the 20%, plus the 3.8% net investment income tax. Okay, that's the idea, right? Here is the question that's being asked. Can you please tell me, if I were to give you these facts, what is the overall tax rate in this distribution, considering the two layers of taxation? right? So, okay, let's go through and work our way on this, right? Corporation, we have a corporation and an individual shareholder. Corporation makes 500,000, they pay 21% on it. 105,000, that's tax 1, right? The first level of tax. Well, guess what? We made 500 and we got to pay 105 on it. That means we have 395 left, right, in the business. We're going to push all of this out as a dividend to our individual shareholder who has a dividend tax rate of 23.8%. So, okay, the 395 plus the 23.8, the shareholder is going to pay 94,000, right? So tax 1 was 105 at the corporate entity level. Tax 2 at the shareholder level is 94,000. So if we added those together, right, the 3 here and 6, it's going to be 199, right? So 500, yeah, 105,000 tax 1, 94 is tax 2. Add them up, there we go. Now, if we were to ask you what is the overall or average tax rate on this, you would say, okay, we made 500,000 and we paid, in this case, 199,000. 7, or if we did 7 right here, the 199 over 1, the 500,000, we would have 39.8%. So this is just breaking it out, right? If you were asked on the exam about this, like what's an average tax rate or something, you just say, okay, I know corporations are taxed at 21%. Tax 1 right there. The individual's taxed at that preferential rate. There's tax 2 there. Add them together, divide it by your total taxable income. There you go. There's your average tax rate. Now, things get a little bit different here if we have a corporation as the shareholder. Remember we said maybe Apple as a corporation buys Amazon stock? Well, in this case, right, if you think about it, there's going to be 3 layers of taxation when it goes all the way through to a shareholder of Apple. In other words, let's say here that C1, so C1 here would be Amazon, distributes a dividend to C2, Apple, right? And then Apple distributes a dividend to its shareholder, right? So by the time it gets to the shareholder who pays tax on it, that's 3 layers of taxation. Apple paid tax on it, on the earnings. What got pushed out to Amazon, Amazon pays tax on the earnings. And then what's left out after that, what gets pushed out to the shareholder of Amazon, pays tax on it. 3 layers. This is too much, right? And the idea here is generally as an overall tax principle, we want to avoid double and triple taxation. So for this reason, what the IRS said is we're going to try and help to mitigate this circumstance. In other words, to avoid triple taxation in the situation where a corporation is a shareholder, we're going to provide this thing called the DRD deduction, which means the dividends received deduction. And essentially what it says is this: C2, in this case, Apple, right? So Amazon, or I'm sorry, yeah, Amazon pays a dividend to Apple. C2 is able to deduct a percentage of that dividend to mitigate triple taxation. Now, the amount, in this case, that Apple would be allowed to deduct would depend on how much ownership they have of Amazon. So in other words, if Apple, in this case, owned 0 to 20% of Amazon, when Amazon pays them a $100 dividend, then Apple Corporation 2 would get a $50 deduction, a 50% deduction. And again, if they own 20 to 80%, they get a 65% deduction. 80 to 100, they get to deduct all of it. So the idea here, right, if you're just trying to keep this straight in your head, what is the point? We have a dividends received deduction. The point of this is to help this guy right here. They're going to give them a deduction from when they got a dividend from a corporation they own, because we're trying to mitigate triple taxation. Now 15.5, you can look at this. It kind of shows what's going on right here, right? We have Corporation 2 right here. They own 10% of Corporation 1. Looks like when Corporation 1 pays the dividend to C2, what's going to happen here is because they own 10%, Corporation 2 is going to get a 50% deduction for the amount of dividend it received. So they're going to receive the dividend received deduction. If we have institutional shareholders, right, so maybe a pension or retirement fund, they own Apple stock, they own Amazon stock. They themselves as an entity do not pay shareholder level tax. Essentially what happens here is when the fund pays out to the retiree in the fund, so if you have a pension fund, for example, maybe you have 100 employees who are funding that. When the pension fund pays out to the employees after they retire, the retirees then pay the tax on those distributions. Finally, here, if you have a tax exempt or foreign shareholder, these are generally going to be exempt from taxation on dividends from a corporation. So when we're talking about, right, double taxation for corporations and things of that nature, one of the things somebody might say is, well, couldn't a corporation just keep the money in the business, right, and not distribute it, and then there's not really that second layer of taxation? Well, that's, one consideration you can do with it, but then probably what'll happen is your retained earnings and things like that, it's all going to be sitting in the business, which will make the business be more valuable, which could drive up the stock price, which then means if you sell your stock in the business, you might have a larger capital gains rate. So there's kind of a give or take here on it. And depending on who you are, right? If an individual, they sell their stock and they have a greater capital gains amount, they might have a greater tax liability. That's 0, 15, or 20. Corporation who are shareholders would pay 21%, and then same as before with tax exempt entities. But here's the deal though, right? That's like maybe one strategy, just keep it in the business. The IRS doesn't like that, right? They want to encourage distributions for corporations. And really what they have here are two separate taxes to encourage this. So a separate penalty or tax that they'll apply to corporations. And the first one here is a personal holding company tax, which basically you have to meet a certain criteria to have this tax applied to you as a corporation. Basically, if you're really a passive corporation, you have a lot of investment income, the IRS is going to hit the corporation with a 20% tax on the undistributed income. Another one here, right? Corporations whose retained earnings, they can impose a 20% accumulated earnings tax. So, hey, if you don't distribute that corporation, we, the IRS, is going to hit you with this 20% accumulated earnings tax. So that way they kind of force their hand to make the distributions to the shareholders, to not just keep it in the business. So there's a little exception to that there. If the business really needs this money to run from day to day, right? I mean, we can't distribute it if we need it. But that's the idea with it, right? You may think, let's not distribute the money to avoid the double taxation, but there are consequences to doing that. It could maybe make the stock more valuable, which would increase the capital gains rate. And then the corporation itself has to balance that out against two potential taxes, separate taxes it could pay. So other considerations you would have here when you're forming a business or you're looking at the tax characteristics, depending on compensation to the owner. So, okay, hey, I come in the door, I want to form a business, and I want it to be taxed a certain way. If I get paid or receive payments from the business as an employee, or if I'm compensated, how would I be taxed on that? So what we would tell that client is, well, we would say it depends on what your, what entity you choose to be taxed as. So if you're an S Corp or a corporation and you happen to be an employee of that corporation or S Corp, you could be compensated through wages and salary. right? You could receive a salary as an employee. Now, the business itself, in that case, they can get a deduction for those wages. And because they're wages, um, it would be like any traditional setup, right? The employer pays half of FICA and you pay half of FICA. So that's like one way for S Corps. Hey, you can be an employee for your S Corp or corporation. If you're a partner in a partnership, how you can get paid is through something called a guaranteed payment. It's kind of like a salary a little bit, but it's a guaranteed payment, like regardless of how the business performs. That's why it's guaranteed. Uh, Now, the partnership itself can deduct this guaranteed payment, right, when they're completing the 1065. However, that's going to be SE income to you, the partner, in that case. In other words, the partnership isn't paying half of it. You're on the hook for all of it. Oh, and it makes sense, right? If you're an employee here, you're paying half. If you're self-employed here, how they're considering it, you got to pay all of it. Sole proprietorship, basically, hey, you make money on that. You're actively participating. That's all going to be self-employment income. And again, you're going to get hit with self-employment income when you're a lot of times when you're a general partner on those guaranteed payments, or when you have your own trade or business, because in all of them you're actively participating. Continuing here, so one of the things that you have to be aware of when we're doing a little bit of a deeper dive on these amounts, if we're talking about S Corp owner compensation, now this is kind of like a classic thing that people do when they're deciding which business entity to be, because there's kind of a tax advantage here. And you can look at the 2 videos I uploaded to explain this with a little bit of a twist on it. But here's the deal, right? If you are a shareholder of an S Corp, and remember we said an S Corp is like a tax status. You first are a tax corporation who elects to be an S Corp. Well, compensation that comes from an S Corp can basically be divided into one of 2 things, right? It can be wages or salary. You can be an employee, or you can receive a distribution from an S Corp of like the income of it that represents your income from the S Corp. Now, one of the things here, right, if you were to look at these 2, which one would you rather have? Right? Well, okay, if I have wages from my S Corp, I'm on the hook for half of FICA, and I don't get any QBI deduction for it. But guess what? If I were to reclassify it as a distribution of income, I don't have any SE tax on it, and I get a QBI deduction. So you can see, right, all day, every day, there's kind of a preference right here, all things being equal. If we had to classify how we're going to push out income from an S Corp to us, you're going to want to call it a distribution of income. Here's the deal, though, right? You can't just put it all as a distribution of S Corp income. The IRS says no, not allowed to do that. If you're working for it and you're an employee, you have to have your distribution at least amount the wages you receive have to be a reasonable amount. In other words, you always have to have, if you're an employee, their wages paid to you for a reasonable amount, right? So basically what's like the bottom line with all of this is people will try to, right? If you're an employee of an S Corp, they'll say, hey, if I have $100,000 a year I'm going to get from this, and I'm working, doing my job, let's say the fair market value of these services I'm providing are $75,000. So that means my wages would be 75, and then the allocation of business income, if you pushed out 25 to me, that's great, right? But why don't we, instead of doing that, making it 75,000 wages and 25,000 of distribution, why don't we instead maybe make it 40,000 of wages? We'll lower the wages and increase the distribution of the income, because that way I can save on this SE tax and get the QBI deduction as well on it. IRS says, no, you can't do that, right? You have to pay yourself a reasonable wage. And reasonable means reasonable, right? Like, what's the fair market value of your services, or what somebody who's doing this job would be expect to be compensated, right? They have different standards for determining that. Now, more specific discussion here with partnership compensation. Essentially, we said here, right, partners compensation can be one of two things. You can have guaranteed payments, which are subject to SE income, again, assuming you're a material general partner, or you can have business income allocations. The main thing here, if you could see, both of it, you're going to get hit with SE tax if you're actively participating. But the idea here is one of them you're going to get the QBI deduction versus the other you won't. So there is kind of a tendency here for partnerships to make it more of a business income allocation. Finally, here's sole proprietorship, right? Basically, the idea with this is all of your income as a sole proprietorship we talked about at Schedule C, you're going to get hit normally with SE tax, and you can get a QBI deduction for it. So before we kind of talk, the next thing here about losses, one of the things I want to just like emphasize here is we're just talking about the rules to play the game. In other words, normally how you would do all of this, it's a facts and circumstances situation. You have to consider all of these rules, right? And then run an analysis. Maybe there's a spreadsheet or a report or some modeling you would do to basically figure out the cost benefit of which entity you want to form and how you want it to be taxed. And the reason I say all of this is just explaining the rules to the game, right? Actually playing the game is a little bit different, but you have to first understand the rules and all the different like good and bad and the characteristics you're considering. So the next thing we're talking about here are losses from a business entity. So, okay, we said, how do we care about the taxation of compensation? What happens if our business has a loss for the year? Do we get to deduct that loss in any shape or way? So corporations, right, if you decide to form a corporation, whether you can use the loss depends on the tax year within which it was generated, right? So basically, if you had a NOL, which means a net operating loss, you have more expenses than you have income on the tax return. If that happened before tax year 2018, basically what you do is carry it back 2 years, to the prior 2-year tax return to offset income in those years, and then you would carry it forward 20 years. So in other words, go back and amend the last 2-year tax returns, to use that NOL to offset income then. And if you still have leftover NOL after that, right, it hasn't been fully extinguished, then you can carry it forward for the next 20 years. If you have an NOL, but after 2017 and before 2021, basically you can carry it back 5 and then forward indefinitely. And if you have an NOL after 2020, basically this is like the most modern rule, right? And what happened here, to give you some perspective, they changed this under the TCJA. That's why it's all funky here with it. But basically the rule right now is if you have an NOL from a corporation during the year, just carry that forward, roll it forward to the next year tax return, where you can offset up to 80% of taxable income. So they made it a little bit less generous, right? You can't offset all of your taxable income. Sole proprietorship losses, right? You have that Schedule C and you have a loss. Generally, you can offset your own personal ordinary income with that. Owners of flow-through entities, oh geez, and we're going to have a whole chapter and discussion on this, but basically if you have a loss from a partnership or on a K1 and you're overall at a loss, deducting that is a very complicated process, and it really involves the passive activity loss rules. There's 3 or 4 different hurdles you have to clear before you can offset ordinary income with it. They do not make it easy. So we're just talking high level here, right? We'll have chapters dedicated that will look at each of these, but at a high level, it's important to know that, yes, you can utilize these losses and depending on the type of entity, there's different rules. These excess business loss rules, what are these, right? These are essentially a way of avoiding letting people take, paper losses on their tax return. I'm not as concerned about them for what they are because they have like a really specific way here of calculating it. but just be aware of like, what is it? What are the excess business loss rules about? They're basically just saying, hey, you can't create all these fictitious losses. We're going to cap them at some point through the excess business loss rules. Now, one of the things, if you're an owner of a corporation, right, that's at the entity level, right? If the corporation, if you own Apple stock and they lose money, right, you don't get to offset your ordinary income on your tax return. In that case, probably what will happen is the value of your shares will go down, but if you don't sell them, it'll be unrealized. But that's the basic idea with it, right? Basically, from a corporate standpoint, the corporation can use a loss depending on when it was involved. Sole proprietor, you can use it individually. Flow through entity, you can use it, but it's tough. And if you're basically an individual shareholder or any shareholder of a corporation, the corporation uses the loss, not you. Finally here, converting entity types, right? So remember I said it's facts and circumstances, right? This is not a one-size-fits-all discussion for we want to be this type of business, we want to be taxed that way. It really depends on the client's scenario and setup. But let's say, for example, why would we want to, if we were a flow-through entity, be taxed as a corporation, right? We may want to do this to utilize the 21% tax rate for corporations. Maybe that looks like a better deal for us. If we wanted to do this, right, how would we do it? Well, there's three ways, right? It depends on your business entity. If you were an S Corp and you wanted to be a C Corp, all you have to do is revoke your S Corp status. If you're an LLC, right, whether you're single member or multi-member, basically what you can do is check the box when you form the business to be taxed as a corporation. Likewise, if you're a partnership or sole proprietor, one of the things you can do is kind of transfer your assets from your pre-existing business into a newly formed corporation. This can be expensive, right? It's, you know, you're forming a new corporation. Continuing here. So maybe you're a corporation who wants to convert to a flow-through entity. Maybe you say, hey, I like that QBI deduction. How can I take advantage of that? Well, in this case, right, you have basically two different options. One of the things you can do is, assuming you meet the qualifications, right, you're taxed as a corporation, hey, make that election to be taxed as an S Corp, right? If you don't meet that, right, you don't meet the S Corp eligibility requirements, one of the things you can do is liquidate the corporation and then form the flow-through entity. But there's tax consequences to that, where you have to weigh that against the benefits of getting the QBI deduction. It's not as simple. So with that, right, a couple things I want to tell you about the homework and the exam for this chapter. One of the things is for the homework, for some reason they make the homework questions in this chapter like very calculation based. So if you get jammed up on it, definitely look the optional problems with it. They make the problems in the book like real simple, but then the homework problems are more complex, and it like presupposes stuff from other chapters. You will not need to know for the exam how to calculate self-employment tax. It'll be told to you what amount they pay. Be aware it's the 15.3%, like the basic setup, but that actual calculation, the 5-step process of doing it, even though you may have to do it in a homework question, or you could see it in the optional problems. Don't belabor that. We've already, I'm not going to test that on the exam because we've already done that in Tax 1, right? So I'm more concerned, high level here, that you understand the characteristics of businesses and what we're talking about. Again, what we're talking about here are the rules to the game. What are all of the variables we would consider if a client came in the door and said, hey, I'm a new client, I have a new business, can you help me? What would our discussion with that client be like? We would tell them the legal part. We would tell them the tax part. We would probably say something like, well, if you did this, that would happen. If you did that, this would happen. we would need to see your financial information as well as ask you a variety of questions so we can model this out and give you the best advice. So with that, that's going to end this chapter here. Make sure you watch the videos on the S-Corp compensation. The videos that I put in this class, kind of the secondary ones, please watch those. Those are fair game for the exam. Sometimes, it's better if somebody makes a professional video or you can hear something a separate way or from a second person. I'm all for that type of stuff because people learn in a variety of different ways. So we'll see you next week, and we'll go from there. Thank you very much.